You own a commercial building, a small office suite, a retail strip, a little warehouse you lease out to a business or two. You bought a policy on it the day you closed, it renewed quietly ever since, and you haven't thought about it in years. Then a fire starts in one of your tenants' units overnight. The building is standing, but the inside is gutted. Your tenants can't operate, so they stop paying rent. And one of them is now pointing a lawyer at you, claiming the building's wiring or maintenance is what caused it. You assumed you were covered. You had a policy. What you're about to find out is that a policy on the building and the right coverage for a commercial landlord are not the same thing. Let's walk through what commercial rental property insurance actually has to do and some of the biggest places building owners get caught. If you don't know who I am, my name's Jim Eddington, and my agency helps individuals and businesses with their insurance every single day. We work with commercial property owners regularly, and leasing space to other businesses is one of the areas where what people assume they have and what they actually have drift the furthest apart. So if you own a building and rent it to a business, this is the coverage conversation to have before something goes wrong, not after. When you lease a commercial space to a tenant, your insurance has two core jobs. Most owners only think about the first one. The first job is the building itself, the structure, the roof, the walls, the wiring, the permanently installed systems. If a covered fire, storm, or burst pipe damages the physical building, commercial property coverage can pay to repair or rebuild, subject to your limits and how the building is valued. The second job is liability. You own the premises and people get hurt on the premises. A delivery driver slips in the shared lobby, someone trips in the parking lot you maintain, a tenant claims the building caused them a loss. As the owner, you can be sued for what happens in the areas you control. Here's the piece that trips people up. There's a specific coverage built for that landlord liability, and in the industry it's called lessor's risk only, or LRO. Lessor's risk is the shorthand for your premises liability exposure as the building owner. But the lessor's risk does not pay to rebuild your building. That's a common misread. The liability piece and the property piece are two different coverages, and a real commercial landlord needs both. Usually they're packaged together in a business owner's policy or a broader commercial package. The point is to make sure both jobs are being done, not just the one you remembered to ask about. Picture a fire in a commercial building you lease out. The building gets repaired, and that part works the way you'd expect. But repairs take months. Your tenants are gone, so the rent is gone, while the mortgage, the property taxes, and the insurance itself all keep coming due. This is the coverage almost nobody asks about by name, and it's often the one that saves the account. On a landlord's policy, it's often called loss of rents, or rental income coverage. When a covered loss makes the building unusable, it helps replace the rental income you would have collected during the repair period, subject to your limit and the policy's terms. That's the gap that turns a survivable loss into one that forces you to sell. When we set up a landlord's policy, loss of rents is one of the first things we look at because it's the part owners most often leave thin or leave off entirely. Now here's the part that protects you the most and costs you the least because your tenant pays for it. Your tenant needs their own insurance, and your lease is what makes that happen. Your policy covers your building and your liability as the owner. It does not cover your tenant stuff, and you don't want it to. Their inventory, their equipment, their furniture, the income their business earns, that's all the tenant's own commercial coverage, and a well-written lease requires them to carry it. But carrying a policy is not enough. The lease should require 3 specific things, and these are the words that matter. Each one only works within what the tenant's actual endorsement covers, so the lease language and the policy have to line up. First, the tenant names you as an additional insured on their liability policy. That means if a customer gets hurt inside a tenant space and sues both of you, the tenant's insurance can defend you, not just them. Second, primary and non-contributory wording. That language makes the tenant's policy pay first, so your policy isn't dragged in to share a loss that belongs to their operation. Third, a waiver of subrogation. That stops the tenant's insurance company from turning around and trying to collect from you after they've paid a claim. Those three terms are the difference between transferring a risk to the party who created it and quietly keeping it yourself. And none of it works automatically. The lease requirement matters, but the actual policy endorsements have to match it, and the tenant has to maintain them, which leads to the mistake we see most. A lot of building owners put all the right language in the lease and then never check the tenant actually did it. The first document you collect is a certificate of insurance. It's a one-page snapshot from the tenant's insurer showing the policies, limits, and dates in force at that moment. But here's the part owners miss. The certificate doesn't amend the policy, and it doesn't prove the scope of your additional insured coverage. To actually verify the additional insured, primary and non-contributory, and waiver of subrogation requirements, collect the endorsements themselves. The endorsement is what actually grants the coverage. The certificate is just the snapshot. You collect these before the tenant moves in, and again each time their policy renews. And here's how the gap opens. A tenant gives you perfect documents on day one. 18 months later, they switch carriers to save money, the new policy never names you, and nobody sends you the update. Then the claim happens, and the protection you built into the lease isn't there anymore. Tracking those documents is unglamorous work, but it's the cheapest risk management you'll ever do. You're not buying anything, you're just making sure the tenant's current coverage still matches what the lease requires. Here's something that surprises a lot of owners. When you insure a building you lease out, the carrier doesn't just rate your building, they rate your tenants. The reason is simple. A quiet insurance office and a restaurant with a commercial kitchen are not the same risk inside the same four walls. The restaurant brings grease, heat, and fire exposures the office never will. So when an insurer prices coverage on your building, the kind of business your tenant runs drives the number. And in a mixed tenant building, the highest hazard tenant can affect pricing and even carrier eligibility for the whole property. This is why a change in tenant matters more than people realize. A clothing store moves out, a small fabrication shop moves in. That's not just new rent, it's a different risk profile, and your carrier needs to know. Swap in a higher hazard operation and stay quiet, and you can have a coverage problem at the worst possible moment when you're trying to file a claim. So when your tenant mix changes, that's a phone call to your agent. We may know a different carrier that fits the new risk better, and it's a far easier conversation before the change than after a loss. There are two traps that quietly wreck commercial landlord claims, and they're quiet because nothing feels wrong until the day you file. The first is insuring the building for the wrong number. There are plenty of owners that insure to what they paid or to market value. But if your building is written on a replacement cost basis, the claim is valued on what it costs to rebuild, not what the property would sell for. And rebuilding costs have climbed hard in recent years. Insure for less than it costs to reconstruct, and a partial loss can come back reduced by a co-insurance penalty. The fix is an accurate replacement cost number with enough limit to satisfy the policy, revisited as construction costs move. The second killer is vacancy, and this one's widely misunderstood. One empty unit usually doesn't trigger it. On a common commercial property form, the vacancy condition kicks in when less than about a third of the whole building is rented and used and stays that way for more than 60 straight days. Once a building crosses that line, the policy changes. Losses from things like vandalism, theft, water damage, and broken glass can be excluded, and payment on other covered losses can be reduced. So the moment a building is mostly empty and most exposed, the coverage shrinks right when you're counting on it. If a string of move-outs could push your building below that line, that's a call to your agent. There are ways to bundle a qualifying vacancy, but only if the carrier knows ahead of time. Silence is how a vacancy problem becomes a claim problem. Let's talk limits for a second because owners always ask. For most commercial landlords, a $1 million per occurrence, $2 million aggregate liability limit is the common starting point. That's the baseline a lot of leases and lenders expect to see. But starting point is the right phrase. If you own a larger property or several, or your tenants draw heavy foot traffic, a single serious injury claim can run past that baseline fast. That's where a commercial umbrella comes in, sitting on top of your liability and extending it well beyond the base limit. The right number isn't just about the building. It's about the exposure and what you have to protect everything a lawsuit could reach. A small single-tenant building and a busy property with a restaurant and a gym are not the same exposure, and the limits should reflect that. So here's what commercial rental property insurance really comes down to. Your policy has to do two jobs: cover the building and cover your liability as the owner. You need loss of rents, so a covered loss doesn't take your income along with your building. Your lease has to require your tenant to carry their own coverage and name you correctly. And you have to collect the endorsements that prove it. And keep your carrier in the loop when tenants change, when a building goes vacant, and when construction costs move your rebuild number. None of that is complicated, but almost none of it happens on its own. It happens because someone set the policy up right and keeps it current. If you own commercial property and you're not sure your coverage is doing both of its jobs, that's worth a real conversation. You can get that started at the quote link below, and we'll go through it with you. We're an independent agency based here in Nevada, and we help commercial property owners in Arizona, Utah, and California too. Because we're independent, we shop multiple carriers to find the one that actually fits your building and your tenant mix, instead of forcing your property into a single company's box. Subscribe to the channel. We publish most business days, and what we cover is for individuals, families, and business owners who want to understand their insurance before they need it, not after. Thanks for watching.